Have you ever wondered what connects the Roman Empire, the Dutch Golden Age, and the modern financial world? It is a force so powerful, it can build empires and then shatter them into dust, speculation. Today, we're diving deep into history, its greatest speculative manias, to uncover the timeless lessons they hold for us. From the fall of ancient civilizations to the collapse of modern giants like Lehman Brothers and FTX, the story is shockingly similar. It's a tale of greed, hope, and the catastrophic consequences when ambition disconnects from reality. Let's travel back to the 17th century to the Netherlands. The Dutch Republic was the envy of the world, a hub of commerce and innovation. But then, something strange happened. People became obsessed with a flower, the tulip. A single bulb could be worth more than a house. This was tulip mania, one of history's first recorded speculative bubbles. Fortunes were made overnight. Everyone from sailors to noblemen poured their life savings into tulips, convinced the prices would rise forever. But they didn't. The bubble burst, prices crashed, and fortunes vanished, leaving a trail of financial ruin. Sound familiar? Fast forward to the 21st century. The names have changed, but the game is the same. Remember 2008? The global financial crisis. Lehman Brothers, a 158-year-old investment bank, filed for the largest bankruptcy in U.S. history. The cause? They had bet billions on high-risk subprime mortgages, packaged into complex financial instruments. They believed housing prices would never go down. This overconfidence, this hubris, created a massive bubble. When it burst, it didn't just take down Lehman, it triggered a domino effect, causing a global recession, massive job losses, and millions of people losing their homes and savings. Investor panic led to massive withdrawals from major banks, pushing the entire system to the brink of collapse. The greed of a few led to over-leveraging and catastrophic losses for everyone. This wasn't a one-off event. Just a few years ago, we witnessed the spectacular implosion of FTX, a cryptocurrency exchange that was once the darling of the tech world. Fueled by hype and a charismatic leader, it attracted billions from investors eager to get in on the next big thing. But behind the curtain was a house of cards. A toxic mix of hubris, incompetence, and alleged fraud led to a dramatic collapse that vaporized billions of dollars in customer funds. The shockwaves rippled through the entire crypto market, taking down other interconnected companies like Genesis. What do all these stories, from tulips to subprime mortgages to digital tokens, have in common? They all highlight the dangers of speculative investing, where the price of an asset is driven by emotion and herd mentality rather than its intrinsic value. People buy not because they believe in the long-term potential of the asset, but because they hope to sell it to someone else, the greater fool, at a higher price later. This creates market volatility and predictable cycles of boom and bust. Psychological factors play a huge role. Herd mentality, the fear of missing out, or FOMO, compels people to jump on the bandwagon, even when their rational mind is screaming danger. We see everyone else getting rich, and we think, why not me? This collective delusion inflates the bubble, pushing prices to absurd levels. But bubbles are inherently unstable. Eventually, a piece of bad news, a shift in sentiment, or simple reality pricks the bubble, and the rush for the exit becomes a stampede. The aftermath is always the same. Widespread financial loss for individual investors and institutions, followed by a scramble for regulatory action. After the 2008 crisis, the U.S. government passed the Dodd-Frank Act, a sweeping set of reforms designed to prevent excessive risk-taking by banks. After FTX, regulators worldwide are now clamping down on the crypto industry. History shows us that these measures are a reaction, an attempt to close the stable door after the horse has bolted. So, are we doomed to repeat these mistakes forever? Not necessarily. The key is to learn the right lessons. The fundamental mistake in all these speculative frenzies is confusing wealth exchange with wealth creation. Trading tulips, mortgage-backed securities, or speculative cryptocurrencies back and forth doesn't create new value. It just shuffles money around, often from the pockets of the many to the pockets of the few, until the music stops. True, sustainable empires, both historical and personal, are built on wealth creation. Think about the great empires of history. They didn't thrive on speculation. They thrived on strategic resource allocation, on building infrastructure, developing agriculture, fostering trade in actual goods, and promoting innovation. They built things that had enduring value. This is the most crucial lesson for us as individual investors. Instead of chasing quick, speculative gains, we should focus on sustainable wealth creation for long-term success. This means investing in companies with solid business models, companies that produce real goods or provide essential services, companies that are actually building something. It means prioritizing investments that create enduring value rather than chasing short-term hype. This brings us to the power of long-term investing. The goal isn't to get rich overnight. It's to build wealth steadily and reliably over time. This approach allows you to harness the magic of compounding returns. where your investment earnings start generating their own earnings. Albert Einstein supposedly called compounding the eighth wonder of the world, and for good reason. It's a patient, disciplined process, but it's the most proven path to financial security. How can you put this into practice? First, diversify your investments. Don't put all your eggs in one basket, especially not a speculative one. Spreading your investments across different asset classes, like stocks, bonds, and real estate, mitigates risk and enhances your potential for stable growth. Second, adopt a long-term mindset. Resist the urge to react to every market fluctuation. History shows that over the long run, markets tend to go up. Panicking and selling during a downturn is often the worst thing you can do. Stay the course and trust your long-term strategy. Third, and perhaps most importantly, enhance your financial literacy. Knowledge is your best defense against hype and bad advice. Understand what you're investing in. Ask critical questions. Is this company creating real value? Does it have a solid business model? Or is its price just being pumped up by speculation? Being an informed investor empowers you to make decisions that align with your financial goals. You might also consider sustainable investing, which looks at a company's environmental, social, and governance, or ESG factors. This approach allows you to invest in companies that not only generate financial returns, but also have a positive impact on the world, creating a different kind of enduring value. Finally, establish clear financial goals. What are you saving for? Retirement? A down payment on a house? Your children's education? Having clear goals helps you stay focused and disciplined, guiding your investment decisions and keeping you from being distracted by the siren song of speculative get-rich-quick schemes. The stories of speculative empires, from ancient Rome to Wall Street, are not just historical curiosities. They are cautionary tales that remain incredibly relevant. They teach us that greed, when unchecked, can overpower reason with devastating consequences. But they also show us a better way forward, a path of patience, discipline, and a focus on creating real, lasting value. By understanding these lessons, we can avoid the pitfalls of the past and build our own, more stable and more sustainable financial futures. Thank you so much for joining me on this journey through history. If you found this insightful, please hit that like button and consider subscribing for more deep dives into the lessons that shape our world. We'd love to have you as part of our community. See you in the next video.